Michael, from your perspective, what are some things that make a great small business investment?
Well, that's interesting. So, as far as a small business investment, I think it all boils down to the operator, like who's operating the small business. Most small businesses are run by the seat of the pants. They don't have SOPs and all that, the detailed information that you want a small business to have. So a lot of times, it's the owners, they're holding things close to their chest or something that you don't know. So, if you get a small business that has those kind of things, I think that makes a better investment because it can run without the owner in place.
Excellent. And what are three metrics that you look at when you evaluate a private business?
Three metrics. Well, I mean, I think the number one is cash flow, right? They always say cash is king, but no, it's cash flow that's king. Uh, um, and those operating expenses, those are things you gotta know. And then the other thing is like, how much liquidity do you have for unforeseen fault of some sort that is going to require some cash. Those two things are definitely paramount. And then you can say the basic things. How profitable is the business? Those are probably the three tops.
Okay, excellent. And how has your investment philosophy evolved over time since you started investing?
Well, I've only done my own deals, right? Um, you know, sure we might have some stock, in different places and so forth. But as far as business stuff goes, I've only done my own business stuff. I'm looking to venture out to do more. I'm a big fan of Cody Sanchez's work. I don't know if you've seen her, the contrarian thinking type mentality, and going out there and doing a bunch of PE type stuff. I think that's really cool, and I definitely want to get more into that space.
Got it. And from your perspective, what separates a good business from a good investment?
Well, I mean, you could say a good investment has the investor more in mind. Like, what's that investor's take? Where a good business could just be a good business, but from an investment standpoint, you might be better putting your money elsewhere because you get a better return from an investment dollar. But if you look short term versus long term, I think that's one way to look at it. I think long term, you can have a good business. It might not have as strong as return in something as a short term, but you're in it for the long haul. And then maybe you're okay with that. You're okay with hey, I don't have, as great a return, but I'm in it for the long haul, looking for appreciation plays or scaling plays or something like that, right? So when you look at it from that perspective, I think those are the key differences you got to look at.
Yes, sir. And how do you find opportunities before the rest of the market does?
Well, from a small business standpoint, that's um, that's probably that's is not really public anyway, right? It's stuff that's being held privately. So all this happens through conversation. I mean, not everything happens through conversation to begin with. So when you turn around and you say, "Hey, I'm going to go look at something," it's networking. I think you go to networking events and you find people that are some person says, hey, this guy over here is selling this. Are you into that? Are you looking for this? And then all of a sudden you get those kind of connections. I don't think you find them otherwise, unless you're out, cold calling at businesses, which you can definitely do. I mean, there's many ways you can go find, business that you might want to invest in or even purchase. I mean, a lot of times business owners don't even know they want to sell their business. They're thinking, hey, they're gonna get to retirement age and they're gonna shut it down. They don't even think about selling it, right? So you can have a brand new conversation with the business owner from that perspective. Like, hey, you ever thought about selling your business? Is this something you want to have a legacy? and move beyond, your retirement age and see it, go into the future, So I think things like that can definitely happen.
Makes sense. And how what would you say is a percentage of deals that you look at that actually end up in a situation where you do make an investment?
So it's probably not a fair question for me at this point because uh, I've only, other than like a real estate play or development play, that's kind of, and again, those are kind of my own deals. Uh, All the other business stuff I've done, it's just been my own ventures that I've taken on. So, um, but I could talk futuristically, like say this next year, if I want to get into the private equity space, you know, finding the right business for me to invest in, and then having more of those kinds of conversations, I think would, uh, you know, I don't know. I'd probably pick a number like how many do I want to talk to a month, and how what's my goal, what am I trying to get to? I think is probably the bigger question, right?
Yes, sir. Absolutely. Are there any red flags that cause you to quickly say no to an investment?
You know, there's always red flags that pop up in looking at anything. A red flag could be, you know, what's the debt ratio, and then how much of a small business is, like as a small business owner, myself, right? I want to write off as much as possible. That if I was to go present those kinds of books to somebody, they'd be like, wait a second, this guy's running like all this, the money's funneling through you as the owner, right? And so, uh, as somebody buying in or investing in a business, you those kind of expenses you want to hold back. Say, hey, no, that you probably don't want to see that in this deal. And bottom line, it just changes your balance sheet, your cash flow ratio a bit. But those are the things I think to understand. Like if I'm financing a new vehicle through my business, right? But just because I want the expense to hit the business, not me personally, or something like that, or maybe there be something else I'm doing, for a tax reason, right? But as an investor, you're like, hey, wait a second, I think that should be separate. I think those would be kind of the things to look for.
Yes, sir. Absolutely. Um, can you walk us through an example of your process from start to finish on an investment you've worked on? From sourcing to buying to ultimately exiting.
Yeah. So um, for me, again, I've done real estate builds and development type stuff. So uh, when I was doing ground up builds, it was always like, hey, am I getting the land at the right price, right? And I don't care if you're buying a land, or if I was going to do a fix and flip or something like that. The entry price is key. Like, in real estate terms, the number one thing is you make money on the purchase, not on the exit. And what does that mean? That means that you have equity in the deal to begin with. If you buy something that has no equity when you close the deal, then you're really don't have any cushion or for upside, other than what you can create. So, and it doesn't mean that you can't maybe see something in the future that's gonna, like, hey, you don't mind paying even value or even more if you know that it's projecting going forward. But uh, when you have things in the market that are, like real estate, which is cyclical, you might, where are you in the trends? Where are things, going? And I just always try to be mindful of that.
Yes, sir. And what are some mistakes you see investors make when evaluating owner operated businesses as investment opportunities?
Oh, again, I think the mistakes on that side of the fence is uh, cash flow or not understanding, hey, there's there could be a hot 3 months and a cold 9 months, right? So understanding when things are good and when things are not as good, understanding the market for that business, I think is key. So that you can say, oh, okay, if you're expecting a return, uh, even every month, it's probably not going to happen that way. And so being aware of that.
Yes, sir. And with that in mind, is there any time where you've walked away from a deal late in the process? Would you be able to speak about that?
Well, again, I can just talk about the real estate deals. I mean, um, I remember buying getting into contract with the deal. This was for like a townhouse or apartment building, and it was pre-construction, and got into it, and um, I didn't have enough contingency time, right? But I was pretty sure it was a deal. And then we saw interest rates change and some other things change. And then I was doing the numbers. I'm like, this doesn't meet the buy box. And I remember having to, give up my contingency money, but I wasn't going to go forward with the deal because of the way the market had turned. And, it's probably a good thing because then the market really turned, and then we'd have been probably holding not the value on the books as we want.
For sure. And Michael, how has diversification helped you when there are those market churns? I understand you're diversified across businesses and real estate. Could you just talk a bit about your thoughts on diversification?
Well, I mean, diversification is good in one aspect and it's bad in another, right? It all depends on where one is in regards to, are you investor or are you managing investor or what have you? Are you owner? Are you more of a passive owner, like in a limited partnership position, or are you more in a general partnership position? I think that's what has to be understood. So, um, you know, um, going back to diversification, I think it's, if you're going to be diversified, know what your strengths are, and then within your strengths, then hey, you probably want to have more of a management role or a general partnership role in that area. And then if it's not in your strength, then you maybe want to be more in a passive role, limited partnership role as an investor.
Got it. And what role does real estate play alongside your business investments? Do you see them as roughly a 50-50 split? Do you find yourself allocating more time or resources to one or the other?
I mean, yeah, that's a good question. It all depends, right? I mean, right now, uh, I'm doing some real estate projects, and haven't done much on the business side, but I know on the business side, I'm about to transition to do more on the business side than I am on the real estate side. But as far as um, I guess the answer to that question is it depends on the time in the season.
Okay, so the time in the season, um, what other factors do you look at in terms of sizing an allocation to a given asset or business?
Well, the, um, sizing is just a function of more dollars, really. When you could have something that's giving you a 20% return over here and something that gives you 20% over there, but the dollars are much bigger. So the I look at more deals like how how is it from a return standpoint, uh, and the speed of the return? I think that really determines where to put your focus, right? I mean, I'm looking at doing 13 townhomes on a new piece of land we located. It's pretty good location, but those 13 townhomes, that's a longer play, right? That's going to be a good 3 year. And that model, I want to do a build to rent. I'm not going to do build to sell. And we might have to sell some of the units, but the idea is to actually have more of a rental, income, a multifamily income coming from that than just a flip or something. So when you look at that realm of what is a good investment, am I, if you don't need cash in the short term, then that's great. If you need more cash in the short term, then look at a different investment, right?
Yes, sir, absolutely. And after you acquire an asset or an investment, what's one of the first things you focus on right after an acquisition to start creating value?
Hmm. Well, you know, from my background in manufacturing engineering and the disciplines in there, I've always found that there's always low hanging fruit, no matter what. Like there's things that aren't uh, simplified or optimized, or that are, where's the efficiency. So that's probably the easiest way to add value. But I think the biggest thing is to have an understanding. Like if I was to go into a business that's operating, all right, even if I was going in as an engineer to work on with, the first thing is just to understand what the system is, right? So you got to give yourself time to really understand, and then before you implement. But there's always, I've seen things where like, oh, like why are they doing that process, or why are they doing that first when that should be last, right? Type thing. And things are out of sequence. And they can, have immediate value or input. On real estate, you can turn around and say, hey, the value add is really, what is the potential, or what it could be, and then what value can you add immediately? I mean, there's many ways to add value in real estate.
Okay, many ways to add value. That makes sense. What are some operational improvements maybe on the real estate side that you've found lead to the highest improvement in returns?
Well, for operations goes, is just making sure that you have your ground rules, your team, communication, right? Yeah, the don't just assume everything's handled. If somebody says it's handled, like follow up, check in, all that kind of stuff. Redundancies. Uh, that's on the management end of just making sure that things are getting done how they're supposed to get done, and without you know um, it being a burden, right? You want to be able to have a quick check in, a quick understanding of what's going on, and if there's an issue or a problem comes up or there's a delay, to understand that from a project management standpoint, right? You want to look at where things are ahead of timeline and what things are behind timeline, and just understanding why. And sometimes it is what it is. It's not like you like, oh, that was misunderstood in the beginning, so hey, this is definitely going to take more. If there's something that happened because of a fault due to some subcontractor or something, then the onus, that's where you really have to push back on somebody not doing their job correctly, or somebody not managing something correctly. Um, in real estate, right? Process is order. What things have to happen in a certain order, and if somebody jumps the gun on something, it can really affect the work of the other trade, right? If I'll in layman's terms, let's just say just say that somebody was a really shoddy framer, and they frame stuff, and studs are not parallel, and on plumb, and or things are out of square. And then the drywall guy comes in. He's like, "What the hell? You know, I did this job to do the drywall work, but now I have to put all this extra time to make special cuts on my drywall to fit on these crappy walls that somebody didn't build square and plumb." You know, that's just a simple example of like of efficiencies that you didn't account for. And again, that goes back to, like, you know, quality assurance, following up, managing, having that communication, checkpoints. That, I hope that makes sense.
Yes, sir. That makes sense. Could you share an example of a case study that you've worked on, and sort of the operational improvements that you made that led to a successful outcome?
Well, case study. I'll just jump into my manufacturing engineering days. And when we want to implement a new process, or, you know, and change. And I think, you know, I don't know if you know the term design of experiments, and you can calculate a design of experiments. You can turn around and look at things from that perspective, but you actually do it. You have to, you know, the things might look good on paper, but you actually have to, you know, get the material, get the resin, get whatever you're doing, get the machinery going, and verify, validate all those aspects of good quality control to say, hey, yeah, this is going to work. And then you implement that. If you go in thinking it's just going to work without doing a trial, a verification, validation, a feasibility study, or something like that, then you're really shooting from the hip.
Yes, sir. And what are some of those risks that you see investors consistently underestimate in sort of the lower middle market private equity area? So things like small and medium size businesses.
Say that again. What are they missing? Rephrase the question. I'm sorry.
What risks do they underestimate? Like when you buy a business, are there things that people sometimes miss or didn't think about before they bought the company?
Um, I mean, maybe they have some bad, you know, past clients. Maybe there's some lawsuit stuff that you don't know about. You know, maybe there's something, you know, it could be legally, it could be something, uh, uh, you know, you know, maybe there's a lot of bad ill will out there because of things that are lingering on from the past, but maybe that's been changed. So that you got things to overcome as far as a new profile or a new persona moving forward. So I think things like that. That's, you can have risk there. I mean, other than, you know, your financial risk, or if 90% of their business is coming from one customer and they lose their, and, you know, you go in and buy a business, and that gives them the okay to exit. They don't want, maybe, you know, that contract no longer is valid, and they exit, and you didn't realize 90% of your money's coming from one source, and, you know, now you got to create new revenue. Things like that could be risk, right? But I think that's just basic stuff. At least it's basic for me to think of it. But, you know, am I answering your question? I hope.
Oh yeah, absolutely. I think that's a great answer. And Michael, I have another question. Consider the following counterfactual. Suppose you and I are sitting here 5 years from now discussing private equity. What changes do you think 5 years from now, retrospectively, we'll look back on and say these are the changes that had the most influence on the private equity market for investors?
Hmm. Well, I, we're in interesting times right now, right? I mean, we've heard this over and over again. I'm sure you've heard this over and over again, that, you know, the baby boomers are getting to retirement age, and those businesses are either going to fold, uh, they're going to be sold, or they're just going to, be closed down, right? So there's an opportunity at this point in time to get into private equity deals, probably in a big way because of people reaching that age and time frame. Plus, with the advances in technologies like AI and so forth, you can create efficiencies. You can have things be done that don't require you to have a bunch of more resource, right? So you can do things more effectively, which then allows the business to grow. So I think those elements, this time is special. I don't think in the next 5 years, we probably don't have a time frame like this. But at this point in time, it is special, and I don't think people realize that.